I've closed over 400 startup deals in the last 4 years, close to 1,000 across my whole career as a lawyer. 7 of them were disasters. And I don't mean the founders were reckless or stupid. Every one of them was smart. Most of them were successful. In a few cases, they'd just been handed the biggest number of their entire life. And they lost it anyway, in a document they thought didn't matter yet. If you're raising money or selling your company right now, you are almost certainly closer to one of these 7 than you think. So I'm going to walk you through all of them, worst to worst. And the last one is the one founders most likely to celebrate while it's happening. Let's get into it. Why I see this so clearly. Quick bit of background first, because it changes how you should hear everything after it. The 2 biggest deals of my career were a $100 million fundraise and a $300 million merger. And those were my first 2 jobs as a startup lawyer. Since then, I've taken founders through raises and exits inside of accelerators like 500 Startups and Plug and Play. 400 deals in the last 4 years alone. But the reason I see these mistakes coming isn't the law. It's that I've been a founder too. I raised money for my own company. I had investors waste months of my time, and I had people flat out try to scam me. As a lawyer, you only ever see how a deal comes together or falls apart on paper. As a founder, you see the whole game, including the parts nobody warns you about. So here's the thread that ties all 7 of these together. The one thing every one of these founders got wrong. Founders think the dangerous moment in a deal is the end, signing the purchase agreement, wiring day. So that's when they finally bring in a lawyer. But by then, it's over. Once you sign the early paperwork, the term sheet, the letter of intent, the first thing that felt casual, the deal is already about 90% done. Every number and every right on that one document is what you're agreeing to for the next 5 to 10 years of your company's life. Everything after it is just filling in what you already gave away. I once had a founder come to me who'd verbally agreed to a $25 million acquisition. He was already celebrating. Then I actually read the documents, and I found an uncapped indemnification clause, almost no protections for him as the seller, and disclosure schedules that were barely half finished. When a founder sends me a deal, the first thing I look at isn't the price, it's the terms. Because the price is the number they show you. The terms are where the money quietly leads. And the person on the other side of the table knows every bit of this. They do this 50 times a year. You'll do it maybe once. So they make the early document feel like no big deal because that's exactly where they win. Every disaster you're about to see is the same move. The founder relaxed at the moment they should have been most awake. 1. The $800,000 that was already gone before I got the call. A founder came to me to close his exit. He'd sold his company, and part of the price, $800,000 of it, was structured as an earnout. Money he'd only get later if the business hit certain milestones after the sale. He'd negotiated the letter of intent himself. His logic was the one that I hear constantly. I'll handle the LOI myself to save on legal fees, then bring in a lawyer to finish the deal. Reasonable, right? He signed it, then he called me. By the time I read it, the buyer had already done 3 quiet things in that casual little document. They'd defined revenue so narrowly that the milestones were almost impossible to hit. They'd pushed the earnout to a 5-year timeline, and they'd stripped him of any control over the part of the business those milestones depended on. So on paper, he sold for a great number. In reality, he came to terms with the fact that he was probably never going to see that $800,000. And there was almost nothing I could do because he'd already signed. Here's what protects you. An earnout is only ever worth the definitions around it. Revenue has to be defined the way your business actually earns it. The milestones have to be the things you still control after the sale. You want a dispute mechanism that sends disagreements to an independent accountant, not the buyer's own finance team. And you want an acceleration clause so that if the buyer fires you, changes the business, or blocks you from hitting the targets, the full earnout pays out immediately. But look at when that fight had to happen. It wasn't at closing. The real deadline was weeks earlier. And the LOI the founder thought didn't matter yet. He brought a lawyer in one step too late. And that sounds like an expensive mistake until you see the next one, where a founder made the same "I'll clean it up later" bet years before there was even a deal on the table, and it quietly poisoned everything. 2. Giving half the company away for an MVP. First-time founder, big idea, no technical co-founder. He meets a developer who says, "I'll build your MVP for 50% of your company." The founder needs the product to exist, so he says yes. In the moment, it feels like a win. He got his software built for no cash. 2 years later, he's raising a real round, and every investor is staring at a cap table where half the company belongs to someone who wrote the first version of the code and hasn't been seen since. And here's what the founder never realized. That cap table doesn't just cost him equity, it costs him credibility. Investors look at a 50-50 giveaway and quietly decide the founder doesn't understand the value of what they're building, which makes the investor wonder what else the founder will hand away once it's the investor's money. Equity is the most expensive currency you will ever spend, because you're paying with a slice of every future dollar the company ever makes. So before you give away any of it, 3 things. Everyone with meaningful equity goes on vesting, so it's earned over time, not gone on day one. Early help that isn't long-term gets paid in cash or a small slice or clearly capped arrangement. And you model what that stake is worth at a real exit. Not today when the company is worth nothing, but at the number you're actually chasing. Same pattern again. The damage wasn't done in the funding round where it finally showed up. The real deadline was years earlier in a handshake the founder thought was too small to matter. Now, at least that one stayed inside the founder's own control. The next one is a landmine that other people bury in your company without you even knowing, and it doesn't go off until the exact moment you can least afford it. 3. The invisible landmine that kills the deal in diligence. A founder had a buyer, a signed LOI, a real price. Everyone's happy. Then the deal moved into due diligence, which is the stretch nobody warns you about. And it's the part that decides whether you actually get paid. It's where the buyer's lawyers go through everything you've built, document by document, to make sure that it holds up. So they found a hole. Some of the company's core intellectual property, the actual product, had been built by an early employee who never properly signed it over to the company. Legally, a piece of what they were selling didn't fully belong to them. To fix it, they needed that former employee to sign an assignment, but he was long gone. The relationship had gone cold, and he wouldn't return calls. IP assignment problems show up in almost every deal I touch. Usually we clean them up quietly. This one couldn't be cleaned up in time, and the buyer walked. A real acquisition died. Not over price, not over strategy, over a signature nobody bothered to collect 3 years earlier. So do this now, while nobody's looking. Every founder, every employee, every contractor, every freelancer who ever touched your product has to have signed an IP assignment putting that work in the company's name. Get it done while people still like you, because in diligence, you can't retroactively force a signature out of someone who's already walked out the door. The real deadline was the day that person started working, not the day the buyer went looking. So far, these have cost founders money and dead deals. The next one costs something worse. It's where a founder does everything right, builds a real company, raises money, and loses the company itself. Raising the money that cost him his own company. You already know this story in its famous versions. Steve Jobs pushed out of Apple the company he built. Travis Kalanick forced out of Uber. Mark Zuckerberg would have been removed from Facebook too if he hadn't held special voting rights that made it impossible. Sounds like something that only happens at that altitude. It isn't. I've watched it happen to founders you've never heard of. Here's the mechanics. A founder raises a seed round, and to close it, he hands the investor a board seat. Feels harmless. It's one seat. Things are friendly. And the founder needs the money. He raises a Series A and he gives up another board seat. And one day, The founder does the math and realizes he no longer controls his own board. The investors do. And a board the investors control can change the direction of the company, force a sale the founder doesn't want, or replace the founder as CEO of the thing that the founder started. This is the one that founders get most wrong, because it never feels like a loss when it happens. It feels like progress. You close the round, the damage only shows up a round or two later when it's structural and permanent. So treat your board like the most valuable thing you own, because it is. Track control at every single round, not just how much equity you're giving up, but how much of your board. Keep investor seats inside a safe range, and stack the board with genuinely neutral advisors and supporters. Design it deliberately. Every raise before you sign, not after you've already lost the majority. The real deadline was the friendly seed round, not the day the founder got voted out. Losing control is brutal, but at least those founders often still had a company worth something. The next founder had a successful exit, a real exit, a number that would make the news, and he walked away with almost nothing. And the math behind how that happens is the part almost no founder sees coming. 5. He sold for $150 million and kept almost none of it. A founder sold his company for around $150 million. On paper, it's the exit of a lifetime. He walked away with almost nothing, because the size of your exit and the amount you actually take home are two completely different numbers, and the gap between them gets decided years earlier, one clause at a time in every round that you raise. The clause that does most of the damage is called a liquidation preference. When investors put money into your company, they don't buy the same stock that you own. They get paid back first when the company sells, often some multiple of what the investor put in before you or your team see a single dollar. Stack enough of those preferences across enough rounds, and you get a version of a great exit where the entire sale price disappears into the investors sitting above you, and the founder, the person who started the whole thing, clears close to zero. There's a second way this happens, and it's quieter. The founder just raises too many rounds. Every round adds more investors who need to make their money back, and at some point, the only exit that returns anything for anyone is a massive IPO. Anything smaller and the sale is a loss for everyone. So the founder gets trapped, chasing a home run that almost never comes, when a smaller, cleaner exit years earlier would have actually paid him. I've watched liquidation preferences quietly cost founders anywhere from a few $100,000 to tens of millions of dollars. And the worst part is always the same. They didn't notice until the money was being wired. So before you sign any term sheet, know exactly what you're agreeing to. Is the liquidation preference one time the investment or a multiple? Is it participating or non-participating? Because participating means the investor takes their money back and a share of everything left over, which stacks hard against you. And model your own exit before you sign, not on wiring day. Run the real numbers and see what actually lands in your account at a realistic sale price. The real deadline was every term sheet the founder ever signed, not the day the company sold. Now, every disaster so far assumed there was at least a deal to lose. The next one is about the founder who never gets a deal at all because of things he did to his own company long before any investor showed up. 6. The company nobody would touch. Some deals don't blow up. They just never happen. The founder goes out to raise or to sell, and the interest quietly dies, and he never fully understands why. Almost always, it's self-inflicted, and it traces back to how the company was run and structured long before he went to market. Messy financials or no real financials at all. A business model where the numbers don't clearly justify an investment. And then the red flags founders create for themselves. Paying themselves an oversized salary out of a company that isn't even profitable. Handing big chunks of equity to advisors and developers. Loaning the company their own money and expecting to get paid back out of an investor's check. Or, and I see this one constantly now, structuring the company with special voting shares and an unremovable board seat for the founder. Because they read online that a founder should protect their control. Here's the thing about that last one. Protecting yourself with heavy-handed structure doesn't read as strength to an investor. It reads as a founder who's going to be impossible to work with. So the exact move meant to protect your company is the move that actually scares the money away. So before you ever go to market, get clean financials in order, ideally looked over by someone who knows what investors and buyers actually check. Keep your own pay and equity arrangements reasonable and easy to defend, and don't bolt on aggressive control structures you found on the internet without someone who understands how a real investor is going to read them. Your company has to survive somebody else's diligence before it can ever get funded or sold. The real deadline was every decision the founder made running the company, not the day he finally went out to raise. And that brings us to the last one. It's the most expensive of all 7, and it's the only one on the list that the founder, his team, and the press will all call a win while it's quietly happening. 7. The exit that was actually a funeral. At the start, I told you the last one of these is the one that founders celebrate. So here it is. We celebrate acquisitions in this industry. The founder posts the announcement, everyone assumes yacht money, the press writes it up as a success, but a lot of the acquisitions we celebrate aren't successes at all. Here's what actually happens in more of these than you'd guess. The company was running out of money. The founder was out raising. Maybe the round didn't come together in time, so their runway ran out. An acquirer, seeing a company with no leverage left, bought it for almost nothing. Sometimes no cash at all, maybe a little stock. The acquisition was really just the founder taking a 9-to-5 job at the acquirer that's dressed up as an exit. And this is the disaster sitting underneath all the others, because look at where it was actually decided. Not in the acquisition. It was decided months earlier, when the fundraise started too late and ran out of road. By the time the deal showed up, the outcome was already set. The acquisition wasn't the event. It was the funeral, which is why the real move is boring and early. Know your runway to the day. Start raising or start exploring a sale long before you're desperate, because your only leverage in any deal is your ability to walk away or get other deals, and you can only walk away if you're not out of cash. The founder who starts the conversation with 12 months of runway and the founder who started with 2 are not in the same negotiation. They're not in the same universe. What I'd tell you if you called me right now. So there they are. 7 disasters, different clauses, different stages, wildly different dollar amounts. But every single one is the same story. The real deadline was never the moment it felt real. It was weeks, months, sometimes years earlier. In the document, the round, or the decision the founder thought was too small to matter. None of these founders lost because they were bad at business. They lost because the other side knew when the real deadline was, and the founder didn't. So let me leave you with the thing I'd actually say if you called me today and told me you just got an offer. If it's an acquisition, the first thing I'd ask is how much cash are you actually getting at close? Not the headline number, the cash in your account on day one. Then, do you understand how they arrived at that number? And then, how are you choosing the right buyer? Because the highest offer and the best deal, almost never the same thing. If it's a raise, I'd ask you 5 things. How much are they investing? At what valuation? With what liquidation preference? Participating or non-participating? And how many board seats do they want? If you can't answer all 5 clearly, you're not ready to sign, and the person across the table from you already knows it. That's the whole game. There's an etiquette to raising money and to selling a company, and it only comes from doing it enough times that you stop getting played. You probably don't have those reps yet. That's fine. I've got 400 of them. One honest caveat. Now let me be straight with you, because not every deal needs a lawyer crawling all over it. If you're doing a small, clean asset sale, simple, low stakes, then heavy lawyering is overkill, and I'll tell that to your face. And if your company is genuinely out of money and you only have one buyer, no other options, then sometimes the lifeline deal is the right call, even on ugly terms, because the alternative is zero. I'm not here to tell you to fight every clause. I'm telling you which fights actually decide your outcome, so you spend your leverage where it counts. If this is you, if you've got a term sheet or an LOI sitting in your inbox right now, or you're about to go out and get one, then that document in front of you is the real deadline, not closing. Now, that's the exact moment that I work with founders. Not to fight everything, but to find the 2 or 3 terms in your specific deal that are quietly deciding how much you walk away with, and to build your list of pushbacks before you sign, not after. I've done it across more than 400 deals, from small acquisitions to raises and exits north of $100 million. And I've sat on the founder side of the table myself. If you want a lawyer who's actually closed these deals to look at your deal before you sign anything, click the first link in the description and book a free consultation with me. We'll go through your exact situation, find where money or control is leaking out of your terms, and map out exactly what to push back on. Again, that's the first link in the description to book time with me. And if you want to see how the single most dangerous of these plays out line by line, the term sheet, where you're agreeing to the next 5 to 10 years of your company in a document most founders skim, then watch this video next.